and welcome to the latest Retire Well episode with me, Matthew. And as always, I'm joined by Joe. And today we're going to talk about how you can structure your pension and your retirement income. Commonly, this is known as bucketing, but we're going to talk about how you can have an investment risk that's right for you throughout retirement and how you can still access funds without worrying about market risk. So, I had a client conversation recently, which was along the lines of, I've had, investments as I've been accumulating and building up pensions. And now that I'm in retirement, do I need to change my risk? We commonly have this conversation. And I think our starting point with those sorts of individuals is it's all about agreeing the right level of risk for the long term. But in the short term, we want to manage those additional risks. So one of those things is sequencing risk. Do you want to have a chat about that slightly, Joe?
Yeah, absolutely. I mean, sequencing risk generally is essentially the risk of taking income when a market's falling, because when your investment drops down and you potentially take money out, it's then much harder to sort of get back to the level that you're at previously.
Yeah.
I think sort of the bucketing strategy in general, and we'll come onto it a little bit more, really tries and sort of, it's more of a psychological strategy as opposed to sort of a technical strategy on where to go, because if people are really worried about investment risk and they're maybe not so comfortable with seeing their investments drop and having to take money out at that time, it might almost flip them around and say that they do want to take money out, and then therefore they've essentially made a bad decision and they won't be able to move back up.
Yeah.
So I almost see bucketing strategy as trying to remove some of those inefficient decisions and sort of push you towards staying invested with the stuff that you can remain invested with.
Yeah, I think when someone's working and accumulating additional pension savings, and even from ignoring pensions, when someone's working, it's easy for them to spend money because it's easy for them to spend their salary. They're essentially spending someone else's money. When they come to that big life event of retirement, whatever it looks like for them, there's an element of that income tap that was coming from employers turned off, but they still have that expenditure. They still have to spend the money. And often we find it's like, taking a horse to water. You can have that first few months where people almost pull back and go, oof, the idea of spending money now, it's mine. It's a bit scary. And I think when we think about the buckets and the pots, whether it's within a pension or whether it's in with cash balances, what that's doing is that's saying you've got an element of security here, a comfort blanket, which allows you to then carry on as normal, regardless of market conditions. So if Trump is causing market volatility with some tweets or some political statements, or when we look back to recent history of COVID, Brexit, Russia, Ukraine for market volatility, as long as someone has got a strategy that works for them for the long-term risk-wise and also has that bucket or that extra flexibility that they're not having to sell distressed assets, then it can almost let them ride the waves of the markets. Do you think that's a fair assessment?
Yeah, absolutely. And I suppose this would be a good time to sort of chat through what different buckets are. Yeah. It is something that I think has become a bit more popular over the last sort of 10 maybe 15 years. What it essentially is, you have three different buckets: a short-term bucket, a medium-term bucket, and a long-term bucket. And we'll talk through sort of how you'd want to structure those different buckets as the episode goes on. But the general sort of theory is your shortest-term bucket will have the lowest level of risk because that's sort of capital that you need access to in the short term, and your longest-term bucket is much higher risk, and it might have more invested in equities because you've got more time before you can access it essentially. And that on a whole allows you to sort of have access to capital in the short term that isn't going to fluctuate, and you're not going to be as subject to sequencing risk on that because it's not going to fall. But equally, you are maximising your investments on the top end and giving them chance to sort of achieve capital growth there.
Yeah. So common question here would be, am I thinking about this strategy inside a pension, or is this my whole financial plan? And I think we would tend to say we're thinking holistically, so we're thinking big picture, but then the actual Lego blocks of how we integrate that can be some personal cash, could be something inside a pension. If someone's got an ISA, we can be adopting this strategy across the board. So really, it's thinking about your own retirement plan, what income you're going to need, and whether that's coming from a pension, an ISA. And I've often talked about income taps, so we can agree with a client how much they want to take, and we can turn on the most tax efficient taps to achieve that. But there's also that comfort blanket of cash saying, I don't know what might happen. If anything happened to the roof of my house, if anything happened to my car, I want to have money in the bank that can pay for it that day. And then if I need to top that up over the next couple of weeks, again, I can then take some money from the other buckets. So again, I think that's, people who haven't retired before go, well, I don't know how much I should have in these buckets. And actually that's where it's what do you feel comfortable with? Someone, I had a client who retired and they wanted to have £100,000 in their cash accounts as their comfort blanket, as their short-term bucket in this example. And that was the right amount for them. If it was a case study and if it was an exam, they would probably have said, oh, you're overweight in cash and you should really move more from the short term to the medium term or the long term. But for them, psychologically, it allowed them to start retirement, enjoy it, and not have to worry about the market.
Yeah, I mean, talking about sort of that exam or the workbook example, the strict workbook example for bucketing strategy is that your short-term bucket should be almost sort of 5 years of sort of immediate needs, and they tend to sort of say that you should split that between an emergency fund of sort of 1 to 2 years, easy accessible cash, and then the next sort of 3 years should be slightly longer term, sort of fixed rate holdings essentially that you don't necessarily need now, but you will need at some point in the near future. I suppose that does go against a couple of things that we've obviously spoken about in the podcast previously. We've spoke a lot about how when clients get to retirement, they actually realise that the cash needed in sort of that they need instant access to is much lower than they actually think it might be.
Yeah.
What are your sort of general thoughts on that? Do you think that's maybe too much in cash or what are your thoughts?
I think the politician's answer is everyone's situation's different. But the one I often say to someone is, when was the last time you spent £20,000 or £50,000 without 2 weeks' notice? And I think I've said it on the podcast before. One clever person had an answer. Everyone else says, good point. The idea of holding more than 50 might be just purely psychological, and actually from a long-term financial plan, they might have said, well, actually, I should really be squeezing some more returns. I should be thinking how I can invest it. So I think what I distinguish differently from the textbook answer that you've described there is I've got the header tank, the drip feed above it, which is the pension or the ISA, for example. And as long as money is liquid or assets are liquid there, that you can get money within 2 weeks to top up your emergency savings, you don't need to have 200,000 or 100,000 in that short-term cash bucket, because you could have 20 or 50 and know that if I've spent that on an emergency, within 2 weeks, something can come in to drip feed and fill that. So I think that comes down to the real importance of someone thinking actively about their plan, thinking actively about how and when they spend money, and then they can behave and react accordingly.
Yeah, absolutely. I suppose to argue the textbook point of why that might actually match your sort of thinking there, when we generally look at it from that view, it's not just your total income for sort of 5 years, it's what you've got guaranteed, and some people might have defined benefit pensions, state pensions, minus what your expenditure is, and for some people, some of our clients, definitely it might only be a few thousand that they need to top up to get to that sort of annual income. So that would bring it down from that few $100,000 down to that sort of small amount.
And to flip it the other way, we talk to a lot of people in retirement where their income, the guaranteed income sources might be higher than their expenditure. So therefore, they should almost be holding a negative cash balance on that scenario. Again, the idea of saying to that person, just have a credit card, don't have any cash, that would be the wrong answer. But you're right, for a year, their cash balance is going to go up. So actually, they need to be looking at that on a yearly basis or every couple of years, just to try and say, if my short-term bucket's there, my mid-term bucket's there, my long-term bucket's there, do I need to jig things around? And I think whilst we talk about what's the right thing to do financially, for me, it comes back down to the psychological bit. It's what people are happy with. So if we think about pensions and lifestyling, the automatic approach for lots of workplace pensions was, we're going to start with a level of risk, and then as you get closer to retirement, we're going to automatically de-risk. And that is essentially to take the active decision out of it and just try and protect that individual. We know from history and bonds and how things have performed, lifestyling's not always worked and it's not always been helpful, but as an idea, it was trying to help the average person. And for us, we almost go, once we're looking at someone's plan and agreeing their level of risk, we would want to turn lifestyling off and actually build a better model that's more bespoke to them. So I think that's where, bucketing is very important for an individual, but actually it might not be formally discussed as bucketing. It might not be formally agreed as short-term, mid-term, long-term. It's more just have you got too much in cash, so you've got too much in the short-term bucket, or have you got nothing in cash and you then could be too reliant on the markets and volatility?
Yeah, absolutely. I mean, just to sort of round up and summarize that short-term bucket, I think it very much is what is right for you, what is going to be the amount that you can hold in cash, which means psychologically you feel better. And the point of it is essentially when there is a market downturn, you can draw from this bucket without having to touch your sort of higher rate ones. And that's why when we look at this, we will be looking at sort of cash accounts, NS&I products, savings bonds, potentially something like that that's no investment risk and pretty easily accessible.
Yeah, and I think just to add one final bit, I think when someone just starts retirement, they probably want to have this bucket slightly bigger than what they expect it to be, mainly because we're thinking about another bucket, and that's the bucket list. And again, if they've got a few things that they want to do and they're going, okay, well, I want to have a round the world cruise, or I want to change my car, or I want to, do something different, there's money involved. So that's almost sat on top of the emergency savings.
Yeah. How long were you thinking about bucket list?
Just for a few minutes.
So moving on, medium-term bucket. This, I suppose, is one that some people definitely use and some people won't use at all. This is essentially, again, textbook example, it'd be something between 5 and 10 years. And I think, 10 years is a long time. So for
5 years is a long time.
Yeah, for a lot of people, they won't actually know how much they would be spending in those 5 or sort of 10-year periods. But generally the goal of this bucket is to just sort of keep pace with inflation, make sure that you will have that money in the future to spend at the rate that you can now, and it's not sort of lost its purchasing power. And then also to sort of try and create an income and top up that short-term bucket sort of as and when you need to access it. Generally, again, it's suggested that this is in more balanced funds, so sort of 50-60% in stocks and shares, which won't be as volatile, but will still sort of give you a chance to sort of perform. What are your sort of general thoughts on this one, Matthew?
I think the medium and the long-term bucket can sometimes be hard for people to distinguish because the short-term one's easy, that's the cash. Then someone who's got a pension, for example, and that's their main asset, they might say, okay, well, what is my medium, what's my long-term? It's all in this same wrapper or this pension, for example. So I think there's an element of going, okay, let's zoom out, bigger picture. And if we factor in something like property, it's easy to see as property as a long-term asset because you're going to have a main residence for the rest of your life, most likely. So you're almost saying that's obviously long-term. The mid-term is almost that balance of, I want something to be invested and I want it to be generating those returns to keep pace with inflation, as you describe. And then there's almost an element of, well, actually, some of that might be even longer term because my pension is to see me through my whole life expectancy and possibly to leave a legacy. So that's going to be invested for, if you're just retiring 20 or 30 years at least. So then you start to say a portion of that is 100% equities because it is for the long term. And then the portion of that is maybe a bit more diverse, a bit more guaranteed, bonds, property, some other exposure. So I think it can be a harder concept to think about, but the way I would almost talk it through with clients is to zoom out and think cash short term, medium term might be more access, something like an ISA that's invested, a pension that you're going to draw down some funds, and then the longer term is more your pension that you're not going to touch for 5 years plus, and maybe things like, property and that sort of thing.
Yeah, I think it can be hard. Just to introduce a long-term bucket, just so we can sort of have a bit more of a discussion.
Because I've always jumped into that one.
Yeah, this is generally sort of 10 years plus, suggested 100% equity, no immediate access, and is very much the engine room for the portfolio that will drive returns. But I do agree with you in the fact that when we're looking at it with clients, a lot of the time we do quite like to have a unified investment strategy across wrappers for a couple of reasons. One sort of it's simple and easy to understand, but two, we also look at the client's risk profile as a whole. So although we might be employing some form of bucketing strategy, whether it's formally or whether the client just has sort of cash separate, when you zoom out and you to look at what that client's risk profile is, let's say it's for sake of example, a 7 out of 10 or something like that on the risk spectrum, which would suggest 70% in equities or something like that. Because you've got so much in a short-term bucket with nothing in equities, and then your actual investment, your unified investment strategy might have 20% in sort of alternatives and 80% in equities. That almost makes that 7 out of 10 risk profile, if that makes sense, and you're essentially employing the overarching bucketing strategy through that sort of unified investment strategy without being as sort of formal about it.
Yeah, I think the easy way to describe what we've just talked about there is when you have advice from a financial advisor, we're doing this behind the scenes without making it 100% obvious necessarily. So we're not going, this is your midterm, this is your long-term pot. We're almost going, how can we achieve that level of risk for you that's right for the long term by managing this and reducing sequencing risk? And if we pause there slightly to go back to the original sequencing risk as what we're trying to protect against, that's the idea that if the markets are falling and you want to take your regular income, are you then selling a higher amount of your investments? So units and investments, every month if the market was falling, you'd be selling more to have the same level of income. So therefore, when the markets then come back up, for example, you then have less overall assets invested and you'd have less exposure. So that's the idea that we're trying to protect against. And one way that we can do that within a pension is to have, say, 6 months worth of your regular income that you're going to take in a cash-like investment, so that when the markets are volatile, you're able to take your income without worrying that you're selling more. And by having at least 6 months there, you then say, well, I've got 6 months for the markets to settle down to a point when I'm going to top up that bucket again.
Yeah, and I think that sort of loss to getting your gain back is an interesting one that not everyone will understand. I mean, if you make a 25% loss on an investment, you actually need to then make a gain of sort of 33.3% to get back to where you were. I mean, a simple one, if you had £100, you'd make 25% loss, you're back down to 75, and therefore you need another third back on that to get back to where you were. And if, as we're talking about sequencing risk, if you're down 25%, not that we'd sort of suggest a risky portfolio like that to most clients, but if you are and then take money out of it, it then just gets even harder to get back to sort of where you were. Okay, so moving on to sort of, I suppose, the overarching benefits of the bucketing strategy when you're looking at structuring your retirement savings. We have obviously run through a couple already, but I think the main one, as sort of reiterated, is it's that structured plan that you have that sort of helps you psychologically when markets are falling to know, look, I've got something in place, we've planned for this, we can continue to enjoy taking the income as we have, just we'll be taking it from the sort of shorter term bucket as opposed to the other two. Matthew, what are your sort of general thoughts on the rigidity of the strategy? Do you think it could be more or less rigid?
I think there's a massive benefit there of knowing that you don't have to turn your income off if the markets are volatile. But there's a balance between having a rigid structure and flexibility of life. So I think, I had a client the other day who messaged me to say, it's not in my long-term plan. And I know last time we caught up, I said I wasn't going to move house, but I've seen the perfect house. How much of tax-free cash could I release from my pension to help me with that, for example? So I think you want rigidity in terms of the risk and to remove sequencing risk, but you still want to be invested in liquid assets that could be used if your plan changes. So my answer to her, for example, was, no problem at all. How much do you think you'll get from yours? What are you looking at making an offer on this? What's the difference? Do you want to have a chat about how we can use that tax-free cash? Yes, we might reduce the flexibility of income for the future, and we might reduce the tax efficiency of income for the future. But if we've ticked off that objective of buying that person's dream house, that's one of the benefits of having a pension and having flexible funds. So for me, it's like almost 80% structure and rigidity, but as long as someone knows there is the ability to change their plans, we know people's health changes, plans change, we want them to be adaptable essentially.
Yeah, and I think it does come down to, again, just being invested. As you mentioned there, most clients that sort of we speak to in the early years of retirement, they will want more cash, to sort of do the things that they've wanted to do, the bucket list as you mentioned, but B, just because they're starting sort of a new part of their life, and it's very different from being employed and spending someone else's income to spending your own income. And sort of the longer that they sort of become clients and become comfortable with investing, the less that they'll be sort of needing to hold to ensure that they aren't making those bad decisions when markets might fall.
Yeah, and I think the bad decision there is the worry and the panic. Again, I had a client recently when Trump caused a bit of market volatility. She hadn't been invested for the long term, and therefore this was the first market blip that she really had seen. And quite rightly, she sort of said, can I have a quick call? And, the conversation was, is this normal? Do we need to do anything? Do I need to worry? I'm reading the Telegraph, and it scares me a little bit. So, the first thing I said was stop reading those articles because they're not very helpful. But actually, when I talked about, this is normal, on a normal year, this is the volatility you see. You still got the portfolio invested in the right way. You've still got your regular income in that low risk bucket. So there's nothing that needs to change in the short term. And now sat here today, her investments are higher than they were at the time when we had that conversation. So for me, it's the bucket takes the risk away that we're helping to manage, and it also helps with the psychological element, but there's still the element of, in the moment, people will still feel a little bit, oof, this isn't nice. Again, I said to a lady yesterday, if your investments fell by 10%, would it impact your standard of living? Would it impact your weekly shopping? And her answer was no, but I would feel a little bit cheesed off. And I think that's the psychological bit that we have to help manage with the low risk elements, with the bucketing, so that someone can actually ignore the short-term noise and actually focus on the long-term picture.
Yeah, speaking about sort of short-term noise, you mentioned newspapers there. They obviously,
and I wasn't slagging off the Telegraph specifically. It's just, in general, it can be fear-driving.
Yeah, they love a story. And I think it is also maybe overblowing the negatives, because negative news sells a lot of the time. But equally, I've seen a couple of things about sort of all-time highs recently, which we've hit in the S&P and the FTSE. And I think it's a bit of an Americanism, sort of an all-time high, and it's sort of, it is something that you could celebrate, I suppose. But in investing, it's sort of exceedingly normal, because if the sort of purpose of long-time investing is to sort of continue growing, you should hit all-time highs quite regularly. And I think if you sort of pay attention to the newspapers and are really on it, you'll think, oh, all-time highs happen, I need to do something with my fund. And it's not necessarily the case. It's just part of that ongoing journey of investing.
And I think if you listen purely to the newspapers, you would have lost your tax-free cash about 10 times. ISA limits would have been cut, and there would be lots of decisions that you would have made that would have been wrong for you. Again, if we jump back to that previous thing with tax-free cash, there was people out there who took all of their tax-free cash because they thought Rachel Reeves was going to try and steal it. Again, that could have been actually the worst thing for them in a time when then inheritance tax was actually an area that was being squeezed, and they could have taken something from that pension, dropped it in their estate. If they're not going to spend it, they're then impacted by inflation as well. So we as advisors are balancing a lot of different risk. We've talked about risk in the past. Again, we talk about investment risk, you talk about inflation risk, longevity risk, sequencing risk. What we're trying to do is juggle all the levels of risk with these individuals to try and almost reduce the worry and to try and tick off those objectives. And I think, one of the best things about the bucket idea is it gives someone flexibility to say, you don't have to worry, regardless of what happens with the markets, your pension can be invested for the long term, and then you can adjust your plan, adjust your income, and we can slowly adapt. Again, it's like trying to steer a large cruise ship. Again, we're not suddenly making big changes. We're not going to be, adjusting the rudder. We're just going to be tweaking it throughout your retirement journey to get you to where you want to be. And I think, again, that's where having a few lifeboats like I'm making this up as I go, like the short-term pots, that can keep people in the short term. If there's any worry, that can give them the security. Yeah. I'm not sure if I love that one, but I'll try again.
Not done too bad. So moving on to the disadvantages, because as advisors, we're always about balance. We've talked about a few of them. I think if you're not doing it through an advisor and you're doing it yourself, it can be quite high management and quite high maintenance. Obviously, you could look at automating it, where you look at sort of moving it from sort of one pot to another, as you go. But if you look at that automated route, you still have sequencing risk because you're not controlling when stuff comes down. So I suppose it's just one more thing to think about in retirement, about sort of, do you have enough in your short-term pot? Do you need to change anything between your medium and your long-term pot? Which might just be something that people maybe don't want. And in that case, maybe you can just simplify it and just have sort of that cash savings pot that you look to sort of top up as and when, and you can draw from when sort of markets turn down.
Yeah, and I think the other thing from a disadvantage, I suppose, is, you're almost relying on an assumption that equities are going to be the highest risk asset, and then you're going to have, bonds and alternative as lower risk, and then cash as being purely secure. As we've talked about in previous episode, cash, there is a chance that cash isn't secure. Again, there's some institutions, you've got limits, so you've got to think about that a little bit. But you've also got to think about, bonds are lower risk than equities, but then anyone who had a pension invested during, Liz Trust's mini budget with quasi-quarteng, again, they would say, well, hang on a second, everything was impacted, and actually you could have been worse in that bond position. And I think that's where, when I go back to the automatic default lifestyling approaches, what I don't like is default without thought. If someone knows the risks and it's an active decision, perfect. If something happens and the market's reacting a certain way, they know what to expect. With lifestyling and that idea of de-risking over time to a set date like retirement age, you could have someone who's on that journey, on that roller coaster, but they don't quite know what they're doing, where they are. And then when something comes along, like Liz Truss as an example, they've suddenly had that flip and they don't know what to do. I spoke to a low-risk individual shortly after that market event, and he said, "Oh, don't worry, my pension's de-risked. They've told me in a presentation recently at work, I'm in a lifestyling strategy." When I looked at his fund fact sheet, it was down 20% in the year because of those market conditions. That was because the risk was a unknown risk for him. Worker said, completely fine. You sit in the default lifestyling strategy, and he then came in and said, 20% down, I'm low risk. This isn't what's supposed to happen. So I would go back to, why are we having these sorts of conversations? It's so people understand the journey, they understand the risk, and they're actively choosing the right level of risk for them.
Yeah, absolutely. I completely agree with that. I suppose other bits of disadvantages we've sort of looked at, could it be overly complex? Maybe, but as you've said, you can sort of simplify it down a little bit. Alternatives are sort of an interesting one that I think we could look at if bucketing strategy isn't necessarily right for yourself. One thing that I think works quite well for some people, and we've discussed it in previous episodes, is looking at purchasing an annuity, which essentially could form that short-term bucket for yourself. Because if you're looking at guaranteed income minus expenditure to get that, if you can get a place where your expenditure is met by guaranteed income and you wanted to top up your state pension or DB pension with an annuity, take some out of your sort of flexible pot of pension and purchase that. That, again, is a psychological measure, which ensures that the lights stay on. You're not sat eating rice and beans, and you can do what you want to do, and keep the other portion of your pension invested. What are your sort of general thoughts on that, Matthew?
Yeah, I think an annuity from a pension is a perfect way of adding some stability. So if someone, say you're 60 and there's a gap between now and your state pension age, which is a guaranteed income like an annuity, you can then say, what do I want to fill the gap between now and then? You could have a portion of annuity. So you're almost saying this is the bills or this is the expenditure. And then I can take the flexible bit on top. And therefore, by having some guarantees, I actually can tolerate more investment risk with the other bit. We've seen that with some of our clients, and buying a partial annuity has been brilliant for some people. One thing that I also like to bang the drum about is purchase life annuities. So again, you could have an annuity, a guaranteed income, which is purchased from your cash balances outside a pension. Again, we talk people through how that's a combination of return of capital and then some growth. So there's a bit of tax to think about. But in general, I've had a few people where they've sold businesses in the past. They've then said, my business used to provide my income. I've now got a lump of capital. How do I then provide my income going forward? Even if they're high risk, they might want to say, I'll have a bit of that annuity, a bit of that guaranteed income to then let me allow my investments to work for the long term. So yeah, I think that's really, really popular, really powerful. And I think it's all about, like we've described, what do you want short term, what do you need mid-term, what do you need long term, and it's just having that adaptability. If someone had rental income from a few properties, for example, they might say, whilst it's not guaranteed, that's my tap of income that's turned on, so I don't need an annuity. But if someone says I've got no guaranteed income and I've finished work, what they're going to change from is once a month, money's going to drop into their bank account from work. That scenario is gone. Where's that money going to come from next? Is it from a pension? Is it from an annuity? Or is it going to be to use cash balances? And I think that's one thing that we've not talked about a lot here. Sometimes people say for the first year or first couple of years of retirement, I'm going to draw down my cash balances. We agree with that logic a lot of the time because you might be overweight cash, but actually some people find it difficult because there's not money hitting the account. So they almost go, I know I've got money there and I know I'm supposed to spend it, but they also come back to that reluctance. So I often say to people, just to manage the psychology of it, move it from one account to another, drop it into your current account like a salary, and therefore you go back to managing the psychological bit of money's coming in, even if it's just moving from one pot to another, that's moving from the medium-term bucket into the short-term bucket to be spent, so to speak.
Yeah, absolutely. And I suppose final sort of bit of alternative that we could look at, or not even alternative, I suppose just maybe a bit of a criticism of the entire strategy as a whole, sort of on this. This is very much about sort of capital growth and allowing yourself to drive the sort of growth of your pension or your investment by leaving it invested, and that sort of anything 10 years onwards should be, in this case, it's saying almost 100% in equities. That's what I'd almost argue, is that right for everyone? There's a number of clients that we speak to that aren't necessarily wanting that capital growth. They've worked hard for the money and they're very much looking at protecting it just against sort of inflation and longevity. And that's when it comes again down to that sort of overarching risk profile. This works really well if you're looking at sort of moving it up, and it might just be a case of adapting the plan. So instead of your long-term bucket being 100% in equities, bringing it down to sort of 80% or 60%, because again, it's another psychological measure. If you're not comfortable with that level of risk, there's no point in taking it, because then your potential to make bad decisions in the future.
I think that's spot on, and I also think sometimes it's reframing the risk. So I spoke to someone yesterday where she would describe herself as a moderate risk investor. As you say, they've worked hard, accumulated more than enough, and it's really for their own viewpoint, they want to just see that be protected. Actually, when we talked about the objectives and the long-term plan, a lot of the money will go down the generations. So when we talked about how long it might be invested for, that's when she's almost in her head now turning the dial up with risk, because it's reforming how long the funds might be used for. And instead of just being 20 years, 30 years, actually, she started talking about the children and grandchildren. So there's an element of going, well, even if she's a moderate risk investor, we can have the cash, we can have the buffer, but actually for the long-term bit, for the bit that we can see being cascaded down, it makes sense for her to turn that up a bit, because she has the capacity for loss, the tolerance that if the markets go up and down, she can allow for that recovery. So I think it comes back down to active decisions and making sure the risk is right for them. If you're a single individual and you're just need to look after yourself, again, if an annuity would give you what you need, even if you're a speculative individual, you could say, I'll take that annuity because I know that's what I want. If flexibility adds more value, that's when you can go, I'll stay invested with drawdown, but I'll still go for the bucket because I still want to be protected against sequencing risk, for example.
Yeah, completely agree.
Perfect. So to conclude, I think a lot of bucketing happens naturally, but you really got to talk to someone like an advisor to work through what's right for you, what's your objectives, what's your plans, and then you can make sure you're not accidentally taking undue risk. Do you think that's a fair sort of wrap up for the overall idea of managing risk and bucketing?
Yeah, as we said, I think it's all about that psychological nature of making sure that you're comfortable with your investment strategy and you've got those backup plans essentially. Okay, so after that summary, thank you very much for watching. If you have any questions at all, feel free to put them down in the comments or send us an email at retirewell@wealthadvice.co.uk, and we look forward to seeing you next week for the next episode.